which we're expecting another cut next month of 2.5%, it becomes a no-brainer. But the interesting thing is that I guess what everyone's been talking about, at least this afternoon, is that there is possibly a chance of a recession developing later this year or early 2014. And the important thing is, what does that mean for the market and the market's outlook? So up until now, we've all been fairly sanguine about where the market's going, 5,500, 600 by year end. How do you think that news today changes the outlook for the market, or does it change it at all?
Yeah, Kim. Look, I think. I was on the show about a month ago, and I think at that time we were saying things are a bit overexcited, certainly with a lot of the yield stocks, and I think that we've gone into a correction in the last couple of months, and with good reason. I think that we're coming out of a mining boom, which was a 1 in 50 year boom. It was an amazing thing to behold, really, for Australians, because it kept us out of a recession for 20 years. So there is going to be adjustment in the economy, there's no doubt. My feeling is it's going to be a bit later than later this year or early next year. I think that the real drop-off in terms of the investment spending in mining comes in late 2014-15. I think that's when we have to really be worried. But we've got a few issues to deal with. We've got the election coming up, and
sure.
I think that's going to keep things a little bit quiet. And I think the big one, of course, is what actually happens to rates over in America. That's all starting to get front of mind for people. But as you say, now that the market's come back, good opportunity to at least start looking at buying some stocks at some good prices.
Tim, you guys don't necessarily spend a lot of time worrying about the macro because you're more, you tend to be more stock pickers. So, where are the opportunities for you at the moment?
Well, Kim, I think maybe I'll start on your first point with the macro, and you're right. We don't focus a lot on the macro because we think there's always opportunities to find good stocks in parts of the economy, but it is, at the moment, I think, a pretty interesting time in macro terms. So we have had a fantastic mining boom, but one of the inevitable consequences of something like that is probably a case of Dutch disease, and I think we, as a nation, need to now experience that. And I'm not sure we've done a great job as a nation of managing the boom in such a way that the hangover when the party ends is an easy one. So there's a lot of structural adjustment that needs to go on now that the surge of capital into the resources sector is not driving up the dollar. It's not causing massive demand for labour and other resources. It's not driving up costs right through the economy. But it's gone on for a long period of time, and the classic victim of that is the manufacturing sector, where labour gets more expensive, everything gets more expensive, and the high dollar means that it's very, very hard to be competitive in export markets. And I think there's going to be some pain probably for a number of years while the economy adjusts to the end of the mining boom, and it really is, I think, upon us now. There's a lot of pain being felt in a number of areas in the resources economy. And I think we're just starting to see the first effects of that now. So in terms of where we see opportunities, I think we're probably more inclined towards companies that have exposure overseas, and we're inclined towards businesses that tend to do a bit better when the economy, or that are not reliant on Australian GDP to drive their earnings, and perhaps we can explore in a bit more detail where some of those sectors might be.
Right, good idea, because we'll move on to our first caller for the night, who just happens to be Kim, and he's from his or her, I'm not sure if they're him or her, but they're from Melbourne, and welcome to the program.
Yes, hi Kim. Thanks very much for taking my call there.
Happy to.
Fantastic. I'm interested to ask about two shares that I hold. The first one is Telstra and the second one is Westpac.
Okay. Ken, Telstra and Westpac, well, as we mentioned, we were talking in the intro, these both look like, to me they look like good buying opportunities, but, in the context of what's happening in the market, should Kim be wading in or waiting?
Yeah, look, Kim, I'm pretty comfortable with both those stocks at the moment. I think Telstra's had a correction back down from over $5 that was probably needed. This asbestos issue with Telstra, we don't think it has the potential at this stage to be a big issue for them. I think it's something that they need to deal with, and so far they've been dealing with it reasonably well, I think, in the way that they've handled the problem. So look, Telstra I think is in an absolute sweet spot still for the next 18 months to 2 years. It is not a long-term growth story, Telstra, and I think for a stock like Telstra to be at the prices that they are now is because they have a fantastic dividend and they are in an absolute sweet spot in terms of their cash flows for the next couple of years. But they look very good for the next 18 months.
The interesting thing about Telstra is that headline growth for Telstra at best is probably going to be about 5 or 6%, and that's in an economy that was we thought was growing at a faster level than it is now. So how much threat do you think there is to the dividend if things really do start to slow down? Because Telstra's only said, well, we're going to guarantee the dividend, I think, for one more lot of 28 cents, and then then it's all bets are off.
Yeah, I think because of the collapse in the competitive position in the mobile market, i.e. some of their competitors have really lost it, Vodafone in particular. I think Telstra really has a good opportunity in the next year or two to keep their revenues up, and of course they've got the guaranteed revenue coming in from the NBN. And that's no longer really under threat from the coalition. That was made very clear by Mr Turnbull recently. So look, I actually think that they look good for the next 18 months to 2 years in terms of their dividend. Thereafter, totally different ballgame. They need to find new growth areas. And I think it's just important that investors don't see this as a potential growth stock. It's not.
All right, well, Tim, we'll throw to you on Westpac. What are your thoughts there?
Look, Westpac, I think, is around about fair value at the current levels, and the big four banks in Australia have such a wonderful market position that over a long period of time you would expect that they should do reasonably well, particularly in a post-GFC world where a lot of the competition has been cleaned up. So I have no issues with investors holding Westpac, CBA, ANZ. We're less keen on NAB, which has a bit of a history of misadventure, but with that exception, I think the big four banks are a sensible place to be. I would say that on Telstra we have a somewhat different view in that we think that while the dividend is great for Telstra, it's really working hard in terms of 100% payout ratio to sustain that dividend. It's a business that doesn't grow. 5 to 6% is I think being kind to Telstra, and we think that the growth potential just isn't there. And what that means is that from a valuation point of view, while the dividend is good, we think that the valuation is probably somewhere in the region of $3. So we're not comfortable with Telstra at these levels at all.
Okay, interesting, because I mean, when you look at Telstra, it does have a 95% payout ratio, so there's not a lot of room there to move if earnings don't actually go the distance.
Yeah, the key for me is timing. I think with Telstra, I agree with Tim in terms of long-term valuation because they don't have the growth potential. But if they can keep their dividend up, and we think they can for the next couple of years, if interest rates are between 2 and 2.75 somewhere, and you're getting a 9+% yield in Telstra, I think they'll get a lot of support.
Okay. All right, it's time for a quick break. Before that, though, it's time to start the stock watch. And Tim, what are you watching? And your time starts now.
I'm watching is QBE. QBE's had a difficult several years, partly as a result of a challenging pricing environment, low interest rates, and a number of natural catastrophes. We think that a number of those issues are likely to normalise in the years ahead, and also that QBE has the ability to benefit from cost reduction initiatives implemented by management. As a result of that, we think there's scope for QBE's earnings to surprise on the upside over the next several years, and the valuation should reflect that.
Welcome back to the program. If you just joined us, Tim's stock watch was QBE. So if you've got a question about shares or stocks, our phone line is 1300 34 35 or email us at yourmoney@skynews.com.au. I think we're going to try and get the chart up on QBE to have a quick look at that, because this is interesting, because obviously QBE is is US facing in terms of earning, big book exposed to US bond yields.
Yeah.
So we've seen obviously that reflected in the share price jumping from $13 to over $15. What are your sort of targets around this stock?
Well, before I get to targets, I think you raised an interesting point on bond yields, and it's something that is I think pretty interesting when you dig into QBE. What you find is that the money that they raise from insurance premiums, they need to invest substantially in bonds for regulatory reasons. And QBE invests in a short-term portfolio relative to its competitors. As I understand it, the tenure of QBE's bond book is something in the order of 6 months. For its main US competitors, you'd expect to see an average tenure of something like 4 years. And that's important, because when interest rates and spreads come down, the value of the bonds held by QBE's competitors has been going up. And that frees up capital that those competitors can use in their underwriting operations. QBE hasn't had the benefit of that, so it's been a little bit on the back foot while that's been happening. As interest rates and spreads widen, the reverse should happen. The value of the bond portfolios held by QBE's competitors should fall relative to the value of QBE's bond portfolio. And that will effectively withdraw capital from the industry, and QBE will have the upper hand. So that's one thing that we think QBE has in its favour. And coupled with that, we think that the pricing cycle that you typically see in insurance is one such that for a period of time no one makes any money, and then prices get forced upwards, so that insurance companies start making good underwriting profits again. And we think we're probably coming into a phase where pricing will start to improve, and QBE's very poor financial performance will start to turn around, we think, in the years ahead. We're hesitant to give targets because valuations change as new information comes in. But as we sit, I think we'd be comfortable ascribing a value to QBE that is perhaps 15% higher than its current price. And as the performance comes through, that could well improve.
Ken, have you been buying this one for your portfolio?
Look, I haven't at this stage, Kim. I think it jumped very quickly, sort of in some ways perhaps a bit ahead of itself in terms of the cycle. But look, I agree totally with Tim. I think the biggest issue is the lazy money that they've had on their balance sheet for a long time.
There's something like $25 billion or something.
Yeah. So I mean, if you imagine rates, move from zero in America, which is what they've been getting on that money, or very close to zero, to up to 3% over the course of the next couple of years, that's a massive difference in terms of revenue.
Yeah.
But the other big thing is the premium rises. I mean, the more natural disasters and problems you have, the more you put your premiums up. And if you look at the premiums in the whole insurance sector, I mean, they've gone up massively in the last 3 to 5 years.
Yeah, if there's no massive disasters in the short term, it's quite easy to see the stock heading towards $20.
Yeah, and I was having a look at some work that one of the analysts had done on QBE, and I think it's pretty interesting because he had actually assumed that there were going to be more disasters as a result of global warming moving forward, but they were still well under still well above the trend line the last 5 or 6 years, which you would think, therefore, that'll come back down a little bit next couple of years.
Yeah, another thing that's interesting is that the type of natural disaster is important. If you have a single big natural disaster, then the reinsurers wear a lot of the cost. If you have a series of sort of smaller to medium-sized natural disasters, if there is such a thing, in the case of QBE, they just get hit time and time again, and there's not as much call on the reinsurers. So it's the type of claims experience they've had as well that's been part of the problem.
It's interesting stock. All right, we'll move on to our next caller from Adelaide, who's Joe. Welcome to the program, Joe.
Oh yes, hello. I was just interested in G8 education, ASX code GEM. I've been following them for the last month and just see that they're fluctuating between $2.20 and $2.30. And I noticed that they're the only childcare business on the registered with the ASX. Mm-hmm. And they're paying quarterly dividends, and I think the last one was 2.5 cents. So I was just wondering what your views were on GEM.
Tim, have you guys got this one in the portfolio?
We don't, and I'm happy to explain why. GM, Joe, it has grown its earnings quite substantially in recent years, and certainly broker forecasts show those earnings continuing to rise. And it's very much an acquisition-driven strategy. They're buying more centres, and the way the theory works is that they buy them at a multiple that's lower than the multiple that they trade at. And there's an instant sort of value uplift because in their hands those centres are worth more. We have a couple of sort of issues with that type of growth. The first is there's no genuine value creation going on. It's a multiple arbitrage rather than genuine additional dollars of profit being extracted from the centres that they're buying. And the other issue is that the growth that is driven by massive capital expenditure really relies on a pretty good return on that capital expenditure in the form of a healthy ROE to sustain share price performance over a period of time. And in the case of G8, we're just not seeing that. They're not getting a particularly high return on equity. So the profits are growing quickly, but shares on issue are growing very quickly also. And that means that EPS growth is hard to come by. It means that there's likely to be pressures on the balance sheet as they proceed. Our valuation for G8 is less than $2. The current share price is $2.22. Mm-hmm. So it's not one for us.
Well, Ken, have you had a look at it?
Yeah, I have, Kim. I think that G8 is an interesting model. I think really the consolidation that Tim was talking about is they basically buy these childcare centres off small mum and dad sort of operators. Yep. and get an immediate uplift because they're a listed entity and they've got a lot of them in terms of the valuation. So they have to keep on acquiring to keep that going.
That in itself has, as Tim was pointing out, has its own set of issues, doesn't it?
Yeah, it does.
If you're constantly relying on acquisition for your underlying growth.
Yeah, and so our valuation just comes in a fair bit lower than what the prices are now. They're also very illiquid stock.
Yeah.
So they're not a stock that they call them for us people who've been in the industry a long time, lobster pots. Easy to get into, but very hard to get out of at the wrong time. So, yeah. Okay.
All right. Thoughts on G8. Our next caller is from Perth. Shayam from Perth. Welcome to the program.
Hi.
Hi, how are you going?
Yeah, good, thanks. How are you?
Not too bad. What can we do for you?
Yeah, I'm just calling with regard to Cochlear. I bought 300 shares at $65 a share. Now it's fallen off to 56 or 57. What's the outlook? Does the panel think, what's the long term? I mean, basically the next 6 months, do you think if the share price will bounce back or will it still keep going down?
Yeah, good question, because we saw a bit of a bounce back in that stock today. It was $53 odd yesterday. It's back to 57, 58 today. Yeah. But to my way of thinking, even at $58, it probably looks a little bit expensive, and I think probably there's more downside in this stock than there is upside. Well,
I think there is in the short term, Ken, because the issue with Cochlear was basically Shane was actually a downgrade to their profits in the current financial year. A lot of that is two real issues here. One has been that they're in between products at the moment, so they're waiting for their N6 product, which looks like it's going to be a fantastic product to come out, and therefore people have been delaying the purchase. And the second issue, which I think the market is trying to get its head around, is whether the growth that's mostly come from the US, they get 40% of their profits from the US, whether the growth that has been there in the past years is going to be there in the future at the same rate. So I think the market is trying to get their head around those issues. My feeling is that there won't be much visibility on that, because the N6 product that has come out, it's only been approved in 2 places. I believe it's Canada and Korea. So it hasn't been yet approved in Europe, Great Britain or US. So it's probably a good 6 to 18 months before we get much visibility over whether that product is winning back some of the market share that Cochlear lost as a result of a few problems they had in terms of that product recall early this year. So, look, in summary, Sham, that's a lot of information, but what I'd probably say is short term, I don't think the price is going to do much at all. Long term, we still think Cochlear is a fantastic story. We wouldn't be buying it at these prices yet.
Tim, interesting because this stock has always traded on a high PE, and everyone's always had a problem with valuations of the multiples it's trading at. But with this pullback, obviously, the PE multiple has come back to something a bit more reasonable. 17 or 18 times could still be a bit expensive depending on your rule of thumb. But obviously, this profit downgrade has created an opportunity to get into the stock. At lower levels. What are you guys doing?
Well, I think Ken's touched on the critical issue with Cochlear. They, at the start of the week, announced that they're expecting profits to fall in the range of $130 to $135 million for the year. Broker consensus the day before was around 156, so it's a pretty big step down. In their announcement, it was a fairly brief announcement, they indicated that there was anticipation of the Nucleus 6 product and slightly slower growth in the US. And it is the case that historically Cochlear has experienced a slowdown in sales ahead of the release of a significant new product as people wait for it. But the fall this time around, it just looks too big to us, and our concern is that the competitive gap that Cochlear has enjoyed for many years may have been eroded for some time now. They've had market share in the 60 to 70% range globally, which is just an astonishing achievement. They've done that with absolutely world-class technology. They've invested very heavily to defend that position. Our concern is that the competitors are getting better, and in particular Advanced Bionics, their largest competitor, has launched some pretty well received products in recent times.
Big parent too, haven't they?
Yes, they have. They have. And that has, our sense is that the gap has closed, and if the N6 product re-establishes that gap, then Cochlear continues to be a fantastic business. Our concern is that the competitors are getting better. Advanced Bionics, they've suffered from product recalls in the past, some of which were safety related, and the reputation wasn't great. It's starting to look as though they may be putting that behind them, getting their act together. And when your market share is 70%, it's very hard to increase it from there. There is the potential for it to decrease if your competitors lift their game. We don't have enough information yet to properly understand all of the drivers behind this downgrade, but that's the issue that really needs to be understood. Has that gap been closed by the competition? If it has, then Cochlear is going to struggle as a valuation play.
I think the market's telling you that in being down 15%, then rallying another 6%. So we're seeing some fairly wild swings.
Yeah, as near as we can tell, and we don't have enough information, but as near as we can tell, the valuation is somewhere between $50 and $60. So it's there now.
Okay, all right. We're going to take a short break, but we'll be back to answer more of your questions in just a moment. So if you'd like to speak with our panel, our number's 1300 34 35, or if you prefer, you can email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. Joining me in the studio tonight is Ken Bloomfield from Financial Clarity and Tim Kelly from the Montgomery Fund. Our phone lines are open on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au. Our first caller back is Michael from Sydney. Welcome to the program, Michael.
Yes, good evening, Kim and panel. I'd like to just pass something by you. I'm currently invested 70%, 30% short-term deposits to equities, and I'm thinking about moving to 50-50 because my income's dropped alarmingly over the last 2 years, and I'm looking perhaps a potential change of government later on this year could be bullish for the market in tandem with the current correction that's going on, which could be a buying opportunity. I'm thinking about moving to 50-50. My preferences are I'm obviously looking for income and stability, and some of the stocks that I had that I'm looking at are Coca-Cola, IOOF, Metcash, and Telstra. Could I get the panel's opinion or all you guys' opinions on what you think of that strategy?
Ken, obviously, this is symptomatic of a lot of people that are self-funded retirees. Being caught in the yield squeeze, having to look for income from equities. So, amongst that selection that we've got there of IOOF, Metcash, Cokes, or Telstra, is there anything that stands out to you, or would you make any other suggestions?
Look, I guess the first thing, Michael, is just from a strategy perspective, I'd definitely be, making sure that you've got your time frames for buying those shares correct, i.e. it really needs to be at least a 3 to 5 year hold for any shares. The thing that I think is that a lot of retirees miss, we're financial planners, our firm, and so we're dealing with retirees all the time. And I think that the thing that they really miss is that the stability of the dividends is extremely important over the longer term. So with cash and fixed interest investments, you get stable capital but extremely variable dividend income, because that's the mechanism the Reserve Bank actually uses to adjust the economy. With shares, if you've got good shares, and generally those three would qualify, you get variable capital but very steady income. So I think a mix of 50-50, depending on your risk profile and all those things, Michael, makes a lot more sense than 70-30 the other way. So I've just run out of time for everyone. Very quickly,
which stocks would?
I like Coca-Cola. A few problems recently, but I like Coca-Cola. I've talked about Telstra. IOOF I think is okay. I think they've done a reasonable job in the consolidation sector. I like AMP better in that sector, but it doesn't pay a fully franked dividend. And I think the other one was Metcash. Not a big fan of Metcash. I think that they'll over time they'll struggle against Wesfarmers and Woolworths.
Tim, to you, there's 3 or 4 dividend paying stocks. Obviously a lot of people have been, I guess, mesmerised by this drop in cash rates, and they've said, okay, well, we've got to get into the equity bond without really realising that there is actual capital risk attached to that particular type of investment.
I think there may be another strategy that people should consider when they're faced with this issue, and that is, rather than just relying on the dividend income from a stock, consider buying stocks that may have perhaps a lesser dividend but stronger earnings, stronger growth potential and stronger total return potential, and actually sell those stocks as the price goes up. And
so in other words, capitalising your income.
Absolutely.
Rather than
in the US, there's been a marked move away from paying dividends for a range of reasons in the US market. But what companies do is they often run buybacks, and people that need cash sell shares into the buyback, and that's the way the company returns cash to its holders. As an individual investor, you can do something very similar just by selling a small part of your holding over time. And what I would suggest, rather than buying a Metcash, which may have a good yield but a weak competitive position, is buy Woolworths, which I think is likely to have very stable and growing earnings, perhaps not as much of a dividend, but the growth in the share price gives you an opportunity to sell some of the shares and bring the value of your capital back down a bit. But if it's growing, that's okay. And I think that may be a more secure strategy in many respects. Leaving that aside, of the stocks that have been nominated, I'd agree with Ken that Coca-Cola is probably the standout there as a good, reliable business.
Yeah, I think the two that stand out there for me is Coke for the capital growth and Telstra for the immediate dividend yield as a combination. Well, we're going to take a short break, but we'll be back with more shortly. So if you'd like to speak with our expert panel, please give us a call on 1300 34 35 or email us at yourmoney@skynews.com.au. Back to the show. If you've got a question you'd like answered, give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com. Our first caller back is Vivian from Melbourne. Welcome to the program, Vivian.
Thank you. Thank you for taking my call.
Happy to.
My question to the panel is that you began the program by mentioning that you would recommend Australian shares with an overseas connection. Which particular shares would you recommend?
Ken, Australian shares that have got, I think what Vivian's referring to here is US facing earnings.
Yep.
What are your top 3 or 4 picks?
Yeah, I think the picks out there at the moment, Vivian, just be a little bit careful because some of these stocks have been bid up quite strongly in the last month or so because people have been rushing in there while the market's been rotating out of some of the more domestic stocks. But the stocks that I like in terms of companies that have overseas earnings include ResMed. So ResMed, Cochlear and CSL are in that healthcare space. They all have high overseas earnings. I think James Hardie is another one that I like. James Hardie is exposed to the US property recovery. I quite like Computer Share, CPU. Computer Share is one of the largest registry managers in the world now. At a business that also has, as we were talking before about QBE, it has a lot of lazy money on its balance sheet, which as interest rates go back up, they can actually make money from as well. And the obvious one probably at the moment is getting a lot of press is News Corp. So there are a few to think about anyway, Vivian.
Tim, anything to add to that?
Look, I think Ken has pretty much covered the bases there. The issue is, as he noted, that a lot of these businesses have been bid up and have held up pretty well when others have started to come down. So it's not easy to find value there. But I think if you can take a long-term view, a lot of these businesses are very, very high quality businesses, and over the long run, it's a great thing to have. So if you can take a long-term view, a lot of the businesses that Ken has named, I think, should do well, even though they're pretty fully priced at the moment.
The interesting one among that selection is News Corp, because we've got that split happening. So it really comes down to how you see the two parts of the businesses being valued post the split. And reading some of the research on it, I'm sort of seeing figures of $38, $39 for the two, and the share price is around that 33, 75, 34. So to me, that is a standout if you're looking for for a valuation play in the short to medium term, in that sector.
Yep.
All right, we'll move on to our next caller, who's Dylan from Geelong. Welcome to the program, Dylan.
G'day, mate. How you going?
Good, mate. Good. What can we do for you?
Mate, thanks for taking the call.
Happy to.
My question's on Ansell. I'm just curious to know what your panel think of the long-term prospects of the business. I'm a user of Tim's scaffold program there, and it looks like it's probably on the dearer side of what the company's worth at the moment, but I'm probably looking to build a long-term portfolio of quality businesses. So I'll be curious to know what the guys think of that business and whether it has any sort of durable competitive advantage in its space. And if you have time, if Tim can maybe just spiel off 4 or 5 businesses that maybe Warren Buffett would love to own if he was an Australian.
All right, you've been nominated as being in the hot seat. So first of all, Ansell.
Okay, let's start with.
Then give away your trade secrets.
Indeed. Okay. Ansell it's not one that we own, but it is one that we've looked at from time to time, and it has been a pretty solid performer, and it's the sort of business that we like. In terms of valuation, the valuation model I'm looking at the moment ascribes a value to Ansell of $17.43 per share, and it's trading at $17.44. So on the one I'm looking at, which is not the scaffold that the viewer sort of may be using, but a slightly different system that we use internally, it looks like there's no sort of valuation reason not to own Ansell at the current prices, and it seems like it's a sort of business that should deliver pretty steady growth over a long period of time. Perhaps if we let Ken comment on Ansell, and I'll gather my thoughts on the other question.
It's not a stock that I really follow, Ansell. We feel like we've got enough exposure in that sector, but I don't really follow it closely.
It usually falls under the category of capital B for boring, doesn't it? But
but boring can be good.
Boring can be good, but that's the attraction of it.
Yeah.
All right, Tim, back to spill the beans.
Indeed. Okay, so the question was, what would Warren Buffett like to own in Australia? And I think, first of all, one of our laments, we're big fans of a lot of Warren Buffett's philosophy, and one of our laments is that there aren't that many really great businesses in Australia. What Warren Buffett, I think, would be attracted to is a business that earns a high return on equity, has the ability to deploy substantial incremental capital over time, and has a market position and competitive advantage that confer pricing power. So a business that can raise prices.
There's always Coca-Cola
over time. There is always Coca-Cola. I think probably what that means in the Australian market at the moment is some of the healthcare businesses that we've already mentioned, and ResMed is one that I think is a particularly interesting business long term. The other area where those sorts of features I think apply are some of the internet businesses, and real estate, or REA Group is an example of a fantastic business that has great market position and pricing power. Unfortunately, from a valuation point of view, we can't get near that one, but one that we think is a bit more tenable at the moment is Seek. Seek is suffering a little bit at the moment, I think, as the market responds to a declining Australian economy and the likelihood that will flow through into fewer job advertisements. If you can take the longer term view, and that's another hallmark of Buffett's style, to look through the short term effects and think about what the business may be able to do 10 years down the track. Seek has a really interesting position in a number of overseas markets, and as internet penetration and migration from print to online develops in those markets, Seek, I think, has potentially a lot more upside than downside. So that is one that I think might fit the bill.
Okay, all right. There's a few good selections there. Okay, it's time for a quick break, but before that, though, it is time to start the stock watch. Ken, you're on the hot seat, and what are you watching? Your time starts right now.
I'm watching Macquarie Bank. Macquarie Bank was the bad boy of the banking sector before the global financial crisis. Really easy way to look at Macquarie Bank now is the old bank part of it, which is the bad bank and the good bank. The good part of the bank really is that they have a very good asset management business, very good lending business, and a very good business in the US in infrastructure. So Macquarie Bank, worth watching. Earnings should increase next couple of years and a good dividend.
Welcome back to Your Money or Call. If you just joined us, Ken's stock watch was Macquarie Bank. Ken, on Macquarie Bank, this is an interesting stock because 3 or 4 years ago this thing had more or less to be rescued by the federal government and almost went to the wall. Looking at the price over the last couple of days, it's back up over $40.
Yep.
And there's quite bullish commentary about it. What do you think the price range on it could be?
Yeah, our valuation of the stock moving forward, a year, 18 months, is up in the $45 to $47 category. So we were buying the stock in the 30s.
Yep.
It then had a very good result about 6 or 7 weeks ago, which I think surprised people on the upside. Stock jumped up to $45. We're just back starting to buy it now. It's back down the $41, $42 range. And yeah, we like it because we think that they're very well structured in terms of their capital adequacy. No problems there at all. They're growing their loan book. Their asset management business helps to fund their loan book. And the bad part of the bank, which is the old part of the bank, the investment banking and the broking, is ascribed value of nothing anyway by the market. So it can only go up from there, we hope.
And Tim, anything to add to that?
No, I think Ken's better informed on that one than I am, so I'll defer to him on that one.
Okay, all right. If you've got a question you'd like answered, please give us a call on 1300 34 35 or email us at yourmoney@skynews.com.au. Our next caller is John from Perth. Welcome to the program, John.
Thank you. Could I please have the panel outlook on gold and their opinion on Magellan Financial Fund?
Okay. We'll see what we can do there. John's after an opinion on the Magellan Fund and also on gold. Gold will probably take us. We can spend all night on that, so let's and not get anywhere. But very quickly, Magellan.
Look, Magellan, John. There's just to be clear about this. There's Magellan Financial Group, who is the funds management company who manages various other funds, and then there's the Magellan Flagship Fund, which is the global fund,
which is the one that John's referred to.
Okay, good. The Magellan Flagship Fund, I think, is it's a well-managed fund. Magellan as a group have been very successful. We have exposure via our clients to an unlisted global fund that Magellan's run, and I've had my clients in that for 4 years now, John. It's been a fantastic performer. It tends to invest in really good top quality businesses. Chris Mackay, who's one of the two owners and founders of Magellan, runs the MFF, which is the one you're referring to. I think it's great to have some overseas exposure in your portfolio, and MFF, even though it's trading a bit above what the assets are worth within the fund, I think if you're going to have some listed global exposure, that's the one to go with.
Obviously, the market's punting on the fact that the value of the fund is going to catch up to.
Yeah, it's trading at a 6 or 7% premium at the moment, but it's quite justified if you look at their performance.
Tim, thoughts on that?
Firstly, I need to declare a conflict of interest. Chris and Hamish, who founded Magellan, are sort of friends of ours at Montgomery. and they actually own a shareholding in Montgomery Investment Management. So we're very close to the guys. So having said that, we think that they are very, very talented managers. We have enormous respect for them, and we expect that investing with them is a very sensible strategy if you want global exposure.
All right, well, let's go to the elephant in the room. Very quick assessment of the gold price. I mean, 30 seconds.
Okay, 30-second assessment. I think that as US normalises their rates and the US economy is recovering, I think gold is really going to struggle. Okay. It might have a bit of a bounce from here back up to test the 1500 mark, but that would be a short-term position as far as I'm concerned. I think it's going to be a tough space to be in.
All right, Tim, we'll let you off on that one.
Thanks. Gold baffles us.
Yeah, I think it baffles a lot of people. Okay, our next call is Andrew from Sydney. Welcome to the program, Andrew.
Hi.
G'day.
The stock I wanted to ask about is MyNetPhone, code MNF.
Yeah.
I remember Ken was positive. I seem to remember he was positive on it not long ago, and I just wanted to find out both panelists' views on it.
All right, MyNetPhone, this has been one of these telcos, like all telcos, that's been belted recently.
Yeah, I'm not sure, Andrew, whether that was the one I was positive on. I was positive on Amcom, Telecom, and I still am. And I actually like iiNet as well in that space. MyNetPhone is a stock that I have looked at in the past, but it doesn't meet our liquidity requirements as a business, so we don't invest in that one. But some good opportunities in that space. I'd definitely have a look at Amcom. I think it's a very well-run business, and it's come down in price considerably in the last month or so. Worth having a look at. A little bit more liquid than MyNetPhone as well.
Well, I mean, I'll take the opposing view because I reckon iiNet's a better view. But let's
and I like iiNet as well.
So across to our value expert, what do you see in this sector?
It's certainly a sector that has been hit very hard recently, and to us, it's a sector where some reasonable value is emerging. And it seems as though it was one of the first areas to be hit in the most recent wave of selling, and it's almost as if people have gotten out of things where they've made a good profit rather than there being necessarily bad news or particularly stretched valuations in the sector. In the case of MyNetPhone, it's a little bit small, and so it's not one that we've been able to look at too closely. There's also no broker coverage on it, which makes it a little bit more tricky unless you've had a proper look at it. But it's one of those telecom business, and it's got a particular niche of voice over internet telephony, which I think is a good space to be in. There's a case that says it's worth somewhat more than it's currently trading at, but you really would need to study the business and the most recent results pretty closely to get comfortable with it.
Okay. All right, it's time to take a short break, but we'll be back with more of your emails and calls in just a moment. Program. If you have a question about stocks or shares you'd like answered, please give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Now let's go to our first email of the night, and it comes from Matt. And Matt would like to know the panel's outlook for SEEK, and we were talking about this recently after the pullback. Also, which stock out of CSL and Cochlear provides better long-term earnings growth? I think we've been around the block on that one, but let's have a quick recap. First of all, SEEK, we were talking about that as as being a Warren Buffett stock, a long-term stock, has been up to $11, and I guess there was a real push behind that stock because people were getting set for what they thought was the imminent listing of the Chinese end of the business. Now that expectation seems to have tailed off, and the stock's come back to a more reasonable valuation, if you can put that reasonable in inverted commas.
Yeah.
Would you be buying the stock at these prices?
Yes, look, I would. I think I'd just wait for it to settle a little bit because it's in a pretty sharp adjustment period at the moment, Matthew. But once the knife sticks, and that is the share price just settles somewhere, which it could in the 8s or the 9s, I'd definitely be looking at the stock. Fantastic earnings growth potential from their international businesses. And I think that's what has got people so excited in the last 6 to 9 months. And it's a model, it's quite nice when you get to test a model and know that it works and then take it and roll it out into economies that are behind in terms of the penetration of the internet and that model. So one of my absolute favourite stocks.
Coming back to Cochlear and CSL, Tim, one of the issues that Cochlear did raise that we did touch on was how sales had slowed down in the US. The question that was running around in my mind today, is that symptomatic, you think, of a general slowdown in medical sales right across all sectors in the US, or is it just symptomatic of the product? Because if there was a general slowdown, obviously it would affect the future valuation of stocks like CSL, for instance.
Yeah, and it was read to some extent as a general slowdown. You saw on the day of that announcement things like ResMed also getting pulled back pretty, to some degree. I think one of the issues that has been raised in relation to the slowdown in Cochlear is what's happening in the paediatric market. So, kids basically, which is a big part of their market, and they're a little bit unusual for a healthcare business in that that's where a lot of their product goes. It's generally you expect that healthcare is directed at the ageing demographic, and maybe they don't benefit from that ageing demographic, and maybe it's more the birth rate that that influences that part of their market. So I think, as we talked about earlier, we don't have enough information to really understand what the drivers are. There's perhaps half a dozen things that could explain what's going on.
What would your thoughts be about CSL?
CSL, we think CSL's a great business. The valuation is not at a point where you'd say absolutely race out and buy it with your ears pinned back. But in the long run, it's a great business, and so if you've got that long time frame, then it's the sort of business that you just buy and hold on to.
And look, the other one in the whole sector, which has been trading on fairly significant valuations, which everyone has always said, is a growth stock but is expensive, has been Ramsay Healthcare, which we haven't really just touched on. So while we're talking about that sector, and we'll wind up on that, what are your thoughts on Ramsay?
Well, Ramsay's a much more capital-intensive business because they're operating in the hospitals. So I think to have a stock like Ramsay at the sort of multiples that it's at now, I don't believe it's got near as much leverage on the upside as something like CSL, ResMed or Cochlear, personally.
Tim, a quick comment?
Yeah, I think the ability to grow overseas is much more apparent for CSL and Cochlear. Well, they've already done it. They've demonstrated that their product can get them overseas. It's harder for Ramsay, so it's a different story.
Okay. All right, we're about to go, and a quick housekeeping matter. A viewer complained about a comment I made on another Sky Business program as racist, so I unreservedly apologise for making that comment. But that's all we have time for today, so thanks very much to our guests Kim Bloomfield for Financial Clarity and Tim Kelly from the Montgomery Fund. And to you, all our viewers, thank you very much for your calls and emails. Until next time, I'm Kim Slater. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.